Hi there, welcome back to the High Tech Business Channel. Today we're going to be talking about Finance 101. We gave that name in our previous video just because we are going to lightly analyze the three financial operators. So what are we going to be looking into? We're going to try to give you tools that you can use using the financial information to provide a very value proposition to your client. In addition to that, we're going to analyze a business case whereby we use the weighted average cost of capital and the internal rate of revenue as an element to analyze our proposal, understanding that the client was using those tools to better take a decision on the values, on the propositions that were offered to him. So actually it is important that your company is about people, it's about products and services, and also about the sector and the sustainability and all of that. But in our world, we're going to be talking about profit, right? So this is highly relevant. And how relevant it is, it becomes so relevant that it's part of the shareholder value equations. The owners of the company, the return of that is important. So the shareholder value equation is something that you want to look into your client size. So you know how your clients, shareholders, are benefiting from anything that you provide to that client. And there are 4 things that you need to keep in mind. That your product and services to your client are going to improve the revenue. That is to say, they're going to be able to sell better, to reduce the churn, to maintain their client satisfaction at a high level, and so on and so forth. Also, you want to make sure that your product or services help your client on the cost and on containing the cost and reducing the expenses. In addition to that, if you can really help your client optimize their working capital, that will be also awesome. And then if you have some financial positioning that can help them better, then you are addressing the shareholder value equation. That, in public companies, there are 3 elements that you need to, 3 financial operators that you need to look into, which is the income statement, balance sheet, and cash flow. Those 3 you need to understand, you need to review into your clients and see, how are they, so you can position your product and services addressing these 3 financial operators. So if you are addressing the income statement, you want to talk to your client and you want to say, hey, Mr. Client, my product and service is going to help you reduce the cost of goods sold, and therefore you're going to have a better net income. So you have to elaborate that a little bit more. On the balance sheet, you can say, hey, Mr. Client, I can help you mitigate liquidity issues that you might have concerning because I have a cost-efficient financial solution that might accompany you. And if you're talking about cash flow, you say, hey, Mr. Client, because I'm going to help you reduce your costs and improve your sales and your revenue, so you're going to have a better cash availability in your company. That happens when you are bringing new technologies and so on and so forth. I have 3 cases here. I'm just going to address the first one, which is the income statement, just for time purposes, but I'm going to leave that for you so you can review, and it will give you an idea of how you have to use these tools often, so your client is more receptive to your solution and you have a better position than your competitors. So let's say that you have a client that you review their numbers and they have net revenue of $1 million. They have cost of goods sold at $400,000, and they have operating expenses of $200,000, and therefore they have a net income of $400,000. So when you look into those numbers, you say, hey, Mr. Client, my product or service is going to help you reduce your cost of goods sold by 10%. And you explain the details, how is that going to happen, right? And if you do that, you're going to improve 10% of your net income, therefore you're gonna be ending up in $440,000 net income, which is a 10% increase. It's great, right? Just because your product and services are, and sometimes you go into single digit numbers to improve your position. So look into your client's net income or your balance sheet or your cash flow and look for the opportunities whereby your products and services are going to be really relevant. And not only that, if you accompany some financial value propositions in addition to that financial package, 3 years financing and so on and so forth, you can help them not use their capex completely on you, and they can use it from the opex point of view. So you have to analyze those two elements quite nicely. I'm going to give you an example of a real situation where we had a client that was a target of ours, and we want to take the ownership of a franchise that was, run by a competitor. So we wanted to enter into that franchise, and the client had issued a request for proposal based on, a budget that they have between $15 million or something like that, and we wanted to win that deal. So our strategy was to put together our product, to heavily discount our product, to put a financial package together, and to do a displacing, a customer shift displacing of our competitors in our favor. And so we did a presentation to the board, and we said what the get well plan was going to be, how we're gonna, that discount, heavily discount that we provide, how we were gonna get it back, and so on and so forth. Right? So this is the situation, and we made finally a proposal which was which mounted $12 million, right? But we also put together a financial package, and that financial package was 2% and 3 years, okay? And some other details there. Our competitors put together a proposal of $11 million. They did also a financial package of 3 years and 10%. They locally were able to get 10% interest rate that they passed to the client. So we knew that the client was going to use two elements, or we suspected that the client was going to use two elements to analyze which value proposition, which the client was going to be. So we knew that they were going to use the weighted average cost of capital, and they were going to use the internal rate of revenue to negotiate better. So the outcome of that was that our WACC, by the way, you have to keep in mind that the cost of equity for the client point of view was 12%. So when they did the analysis, the WACC in our case was 9%, and the WACC of our competitors was 11.4%. So in this case, the client decided to go with our WACC because it was less than the cost for them. The cost of capital was going to be less than what they had, and our competitor was higher. Obviously, they had 10%, right? Then they they additionally did an analysis analyzing the impact that they had on the cash flow of those technologies were going to have. So those technologies were going to impact the cash flow that they had, and they were going to be improved in such and such a way. So we had $8, $10, and $12 million cash flow for the next 3 years. So they put, so you take you do the net present value, you put it in zero, and then you get the internal rate of revenue. You can do the math yourself, and then they encounter that our solution was 59%, and our competitors was 67%, because obviously they had a capital expenditure of $1 million less than us. But the overall situation was that the client decided to get our technology with our financial package, because the weighted average cost of capital is a more balanced, and it impacts the complete financial structure of the company, whereas the IRR is mostly for a specific project, and sometimes you need to do one per technology and so on and so forth. Now, when you use the WACC, you use the complete financial structure of your client, so therefore the impact is more, reduces the risk. So the client decided to acquire the technology from us, and we were able to displace our competitor, and we then owned that franchise, which represented many more millions of dollars within the next few years. So what I want you to keep in mind is when you are doing your account plans, you need to pay a lot of attention to the financial of your clients. You need to understand that, and that's specifically important if you really want to differentiate yourself from your competitor. You need to analyze the liquidity, you need to analyze different stuff that might be helpful. And also don't learn and use the WAC. And there are many, I think you can Google how to do the WAC, or there should be some automated tools there that you can use to calculate the WAC, and so you can really analyze that from that perspective. And if you are able to voice that to your client, you're gonna be much more successful. So this is all for today. I hope you like the video, and if you like it, please ring the bell and subscribe for more. Our next video is going to be about game theory applied to account plan and to the business. So I hope to see you in the next video. Stay safe.